Welcome back to All About Economics. We have covered bonds and stocks. Now we reach the instruments that intimidate beginners more than any other, options. They sound complex and risky, but the core idea is something you already understand because you use it every year, insurance. Today we will demystify options completely. You will learn what a call and a put really are, the all-important strike price, how a put option protects your portfolio just like car insurance, how it can also let you profit when a stock falls, and finally the two secret ingredients that make up every options price. By the end, options will feel less like a casino and more like a precise, powerful tool. Let us crack the code. Section 1. What an option is. An option is a contract that gives you the right, but not the obligation, to buy or sell an asset at a set price by a set date. That phrase, the right but not the obligation, is the whole essence. You are not forced to do anything. You simply hold the choice, and you pay a small price, the premium, for that choice. There are two flavors. A call option gives you the right to buy an asset at a set price. You want it when you expect the price to rise. A put option gives you the right to sell an asset at a set price. You want it when you fear the price will fall. Calls are a bet on up, puts are a bet on down, or a shield against it. Section 2. The put as insurance. Here is the idea you already know. When you own something valuable, like a car, you protect it against a worst-case scenario with insurance. You pay a small premium, and if disaster strikes, the insurer covers your loss. A put option is exactly that, insurance for your stocks. Imagine you own shares in a company you believe in, but you have a nagging fear the market could nosedive. You buy a put option. You pay a small premium, and in return you get the right to sell your shares at a guaranteed price, no matter how far they crash. If the stock plunges, your put pays off and covers the loss. If the stock stays fine, you simply let the put expire, having paid only the premium, just like an insurance policy you never had to claim. Section 3. The strike price. The single most important number in an option is the strike price, the fixed price at which you can buy, for a call, or sell, for a put. It is your guaranteed price, the level locked into the contract. For a put used as insurance, the strike is the floor below which you cannot lose, the price at which you are guaranteed the right to sell. Choosing the strike is like choosing your insurance deductible. A higher strike on a put gives you more protection, the right to sell at a higher price, but it costs a bigger premium. A lower strike is cheaper but protects you only against a deeper crash. The strike price is where you dial in exactly how much protection or how aggressive a bet you want. Section 4. Expiration. The second key term is the expiration date, because options do not last forever. Every option has a deadline, after which it simply ceases to exist. This makes options fundamentally different from owning a stock, which you can hold indefinitely. With an option, you are not just betting on direction, you are betting on direction within a window of time. Your view must be right before the clock runs out. This time limit is crucial, and as we will see, it is one of the two ingredients in an options price. The further away the expiration, the more time for your bet to come good, and so, all else equal, the more the option is worth. Time, in the options world, is literally money. Section 5. Profiting from a fall. A put is not only a shield, it can also be a sword. Suppose you do not own a stock, but every signal, all your research, screams that it is overvalued and a crash is coming. How do you act on that conviction? You buy a put option. If you are right and the price tumbles, your put, the right to sell at the higher strike, soars in value, and you profit handsomely from the very drop you predicted. This is how investors position themselves to make money when things go south, rather than just avoiding losses. It is the mirror image of buying a stock. Where a stock buyer profits from a rise, a put buyer profits from a fall, with the risk capped at the premium they paid. Section 6. Calls, the bet on up. The call option is the optimist's instrument. It gives you the right to buy an asset at the strike price, so you want it when you believe the price is heading up. If you buy a call with a strike of 100 and the stock soars to 150, you can still buy at 100 and instantly capture the gain. Your profit grows with every step the stock climbs above the strike, while your loss is limited to the premium you paid if the stock disappoints. This is the magic of options, asymmetric payoff. With a modest premium, you gain large upside exposure while capping your downside. That leverage is what makes options powerful and, used carelessly, dangerous. The very same leverage can multiply a small stake into a fortune or wipe it out entirely, which is exactly why options demand respect. The force that thrills a reckless speculator is the same force that protects a careful hedger. It all comes down to how you choose to use the tool. Section 7. Intrinsic value. Now we crack the code of an options price, which splits into exactly two parts. The first is intrinsic value, what the option is worth right now if you exercised it this instant. For a call, it is how far the stock price sits above the strike. If a call lets you buy at 100 and the stock is at 120, the intrinsic value is 20, the immediate, real, in-the-money worth. If the stock is below the strike, the call has zero intrinsic value. You would not exercise it. Intrinsic value is the solid, tangible part of the price, the profit locked in if you acted today. It is the floor an options price cannot fall below. Section 8. Time value. The second ingredient is time value, and it captures possibility. It is the extra amount, above the intrinsic value, that investors will pay for the chance that the option becomes more valuable before it expires. Even an option with zero intrinsic value, where the stock is below a call strike, still has worth, because there is time for the stock to rise. So the full formula is simple and complete. An options price equals its intrinsic value plus its time value. Time value is highest when expiration is far away and shrinks toward zero as the deadline nears, decaying away in a process traders call time decay. Once this clicks, every option price stops being a mystery. It is just what it is worth now, plus what it might become. Conclusion. We have cracked the code of options. An option is the right, not the obligation, to buy or sell at a strike price by an expiration date, a call to bet on a rise, a put to bet on, or insure against, a fall. A put protects your stocks like car insurance and can even profit from a crash, while a call offers leveraged upside, both with risk capped at the premium. And every options price is just two parts: intrinsic value, its worth right now, plus time value, the price of future possibility. With these foundations, options become a precise tool rather than a gamble. Next, we combine options into real strategies, the spreads the pros use. If this demystified options, please subscribe to All About Economics and share it. See you there.